For 50 years, a system held firm. Paper contracts, infinite leverage, and the illusion of abundance. But something changed in March 2022. The day Russian reserves were frozen, gold began moving differently. Not speculation, not market noise, something deeper, structural, irreversible. Central banks can no longer suppress what they cannot deliver. 850 million ounces mined annually, 1.3 billion ounces demanded. The mathematics are unforgiving. When the paper market breaks, it won't stop at silver, gold, credit, currencies. Everything moves at once. The countdown has already begun. And what comes next will redefine wealth itself. Welcome to Boring Currency. If you've reached this point in your journey, you understand that truth rarely arrives with fanfare. We're not here to entertain. We're here to analyze. Before we proceed, may I ask you to do something quite simple? Subscribe to this channel. Not because it's trendy, but because the information that follows may prove essential in the months ahead. Also, kindly share with us in the comments from which part of the world are you watching this briefing. Your perspective, your geography, matters in what's unfolding. Now let us begin. For half a century, a carefully constructed system has governed the price of gold and silver. It was not built by accident. It was designed with precision, maintained with discipline, and protected with institutional power. But systems built on paper eventually meet the limitations of physical reality. The mechanism was elegant in its simplicity. Paper contracts, derivatives, futures markets. They allowed the trading of gold and silver that did not physically exist. For decades, this worked. Traders bought and sold promises. Few ever demanded the actual metal. The system functioned because confidence held firm. But confidence is fragile. In 1976, the COMEX began trading silver contracts. It marked the beginning of what analysts now recognize as the longest price suppression campaign in modern financial history. The goal was never profit. The goal was control. When gold rises, it sends a signal, a warning. It tells the world that fiat currencies are weakening. It reveals what central banks desperately need to hide. That unlimited borrowing has consequences. Gold became the thermometer. And when the thermometer showed fever, they broke it. Silver followed the same pattern. But silver was easier to suppress. The market was smaller. Global annual production sits around 850 to 900 million ounces. In dollar terms, that represents only 40 to 50 billion annually. In today's multi-trillion-dollar financial system that is remarkably small, a market that's small can be controlled. Paper contracts can flood the system. Prices can be pushed down. Speculators can be scared away. For years, it worked flawlessly. Central banks around the world participated. They leased gold into the market. The gold was sold to suppress prices. The strategy was coordinated. The purpose was clear. Keep gold quiet. Keep silver subdued. Maintain faith in paper currencies. Enable governments to borrow without limit. But there was a flaw in the design. The flaw was this. Suppression only works when demand remains theoretical. When buyers are satisfied with paper promises, when physical delivery is rare, the moment people begin demanding actual metal, the system faces an impossible equation. And that moment has arrived. Annual silver production cannot meet annual demand. Approximately 1.3 billion ounces are needed each year. Mining supplies less than 900 million. The gap is significant. For a while, above-ground stockpiles filled the deficit. But stockpiles are finite. They deplete. And when scarcity becomes visible, prices must adjust. This is not speculation. This is mathematics. Silver is not merely a monetary asset. It is an industrial necessity. Technology requires it. Medicine uses it. Solar panels cannot function without it. Defense systems depend on it. Electric vehicles need it. The global transition to renewable energy has created unprecedented demand, and that demand is non-negotiable. When people are told an asset is unavailable, demand intensifies. When supply cannot meet demand, only one mechanism remains. Price must rise. There's no alternative. The market will balance itself. The only question is how violently. For decades, short positions dominated silver markets. Institutions sold contracts far exceeding available physical supply. This worked because settlement was usually in cash. Buyers accepted dollars instead of metal. The system never faced a stress test, but stress tests eventually come. Now participants are changing behavior. They're demanding delivery. They want physical metal, not promises, not paper, actual silver, actual gold. And the institutions that sold those contracts do not have the metal to deliver. The banks are now losing billions, not because they planned poorly, but because the strategy that worked for 50 years has reached its limit. The thermometer is repairing itself, and the fever it reveals is severe. This is not a temporary disruption. This is structural failure. Bill Halter, a financial analyst with decades of market experience, describes the situation with clarity. He explains that once countries witnessed how easily reserves could be frozen or seized, something shifted. A psychological barrier broke. Nations began questioning what truly constitutes safe money. Gold and silver prices began climbing slowly at first, then persistently. The movement was not driven by speculation. It was driven by the erosion of trust in paper promises. The question is no longer whether the system will break. The question is what happens when it does. There's a moment in every failing system when the rules change overnight. Not gradually, not with warning, but suddenly, decisively, and without mercy. History provides the blueprint. The year was 1979. Two brothers in Texas decided to challenge the system. Nelson Booker Hunt and William Herbert Hunt were not ordinary investors. They were billionaires. And they understood something that few others recognized at the time. Silver was undervalued, dramatically undervalued. They began accumulating not through paper contracts alone. They bought physical silver, millions of ounces. They took delivery. They stored it. They controlled it. And as their position grew, the price began climbing. Silver moved from $5 to $10 to $20 and eventually touched $50 per ounce in January 1980. The Hunt brothers were winning, but they made one critical mistake. They used leverage. They traded on margin through the COMEX. And the moment the exchange realized they were losing control, they rewrote the rules. On January 21st, 1980, the COMEX announced new regulations. The exchange would no longer accept buy orders in silver futures. Only sell orders would be permitted. Think about that for a moment. In a supposedly free market, buyers were banned. Only sellers allowed. Silver collapsed. From $50 to $10 in less than 8 months, the Hunt brothers were bankrupted, their empire destroyed. Not because they were wrong about silver, but because they relied on a system that could change the rules when threatened. The lesson was clear. In a cash and carry world where physical metal is held outside the system, this could not have happened. The Hunts would have been untouchable. It would have taken longer. It would have required more capital. But they could have cornered the market. Instead, leverage destroyed them. That was 45 years ago. Today, the same dynamic is emerging, but on a scale the Hunt brothers never imagined. The COMEX and similar exchanges have sold silver contracts far exceeding physical supply. For decades, this posed no problem. Settlement occurred in cash. Buyers accepted dollars. The metal never had to change hands. The system ran smoothly because participants played by unspoken rules. They did not push for delivery. They did not expose the shortage. But now they are pushing. More buyers are standing for delivery. They want the actual metal. And the institutions that sold those contracts do not have it, cannot get it, and cannot make it appear. This is where the situation becomes dangerous. A failure to deliver in silver does not remain isolated. Markets are interconnected. Confidence is contagious. The moment silver delivery fails, questions spread immediately. What about gold? What about platinum? What about palladium? What about every other commodity traded on futures exchanges? Investors begin wondering, have they oversold wheat? Have they oversold oil? Have they oversold copper? The doubt spreads like fire through dry timber. And once doubt takes hold, trust collapses. This is not theory, this is pattern recognition. Bill Holter warns of exactly this scenario. He explains that once one market breaks, the contagion moves into others. Not because the fundamentals are connected, but because confidence is universal. When investors realize that contracts are not backed by physical assets, they question everything, every promise, every obligation, every derivative. And then the credit market sees. Credit is the foundation of the modern economy. Every business, every transaction, every paycheck, everything runs on credit. Lending, borrowing, promises to pay in the future. It all depends on trust, on confidence, on the belief that obligations will be honored. Remove that trust and the system freezes instantly. Halter uses a simple illustration. Remember Wimpy from the old Popeye cartoons? His famous line was, "I'll gladly pay you Tuesday for a hamburger today." That is credit, a promise of future payment. But what happens when people stop believing Tuesday will come? When they stop trusting the promise, everything stops. Banks stop lending. Businesses cannot operate. Supply chains halt. The real economy, the one that produces food, energy, and goods, cannot function without credit. And the financial economy, stocks, bonds, derivatives, depends on it even more. When silver fails to deliver, when confidence breaks, credit markets hiccup. And if credit ceases even briefly, the consequences are catastrophic. This is why governments have prepared. They have passed laws, updated regulations, created legal frameworks. They call it the Great Taking. The infrastructure is already in place. The ink is dry. These laws were not written as precaution. They were written to be used. And what comes next is not accidental. Gold and silver cannot default. They cannot go bankrupt. They are physical assets. They hold value regardless of institutional failure. But the world around them, the system of debt and derivatives, is entering a default phase. Too much debt exists. The money to repay both principal and interest does not exist. It never did. So they print, they expand money supplies, they inflate, and in doing so they dilute the value of every currency. The currencies fall and gold and silver simply reveal that fall. They do not rise. Currencies fall. The distinction matters profoundly. While Western institutions were busy engineering paper markets, the East was quietly buying the physical metal. This was not impulsive. This was not speculative. This was calculated strategic. And it has been happening for over 15 years. China tells the world it holds approximately 3,000 tons of gold in official reserves. Financial analysts who examine trade flows, mining production, and Shanghai Gold Exchange data tell a very different story. The evidence suggests China's actual gold reserves exceed 35,000 tons, perhaps significantly more. That is not a small discrepancy. That is deliberate concealment. Consider the mathematics. China produces roughly 400 tons of gold annually from domestic mines. It is the world's largest gold producer. None of that gold leaves the country. All of it stays within Chinese borders. For 15 years, that alone accounts for 6,000 tons. But that is only domestic production. Now add imports through the Shanghai Gold Exchange. Thousands of tons have flowed through that exchange over the past decade and a half. Analysts have tracked the shipments, documented the deliveries, calculated the accumulation. The numbers do not support a 3,000-ton reserve. They support something far larger. So why the secrecy? Because revealing the true scale would trigger immediate global repricing. It would expose Western vulnerabilities. It would accelerate the very crisis China is preparing for. Strategic accumulation requires silence. When you are repositioning for a monetary reset, you do not announce your preparations. China is not alone. India has maintained a cultural relationship with gold for centuries. Citizens hold thousands of tons privately. The government continues accumulating. Russia has been aggressively adding to reserves for years, quietly, consistently, without fanfare. And then there are the BRICS nations: Brazil, Russia, India, China, South Africa, the original five. But the bloc has expanded dramatically. Over 140 to 150 countries have now joined or expressed interest in joining. That represents more than half the world's geography, more than half the global population, and a clear majority of future economic growth. These nations share one common understanding. The dollar-based system is unsustainable. They recognize what Western governments refuse to acknowledge publicly. There's a fiscal mathematics problem. Debt has grown beyond any possibility of repayment. The numbers do not work. The equations do not balance. And when something cannot continue, it will not continue. There are two types of sovereign default. The first is non-payment. A country simply refuses to pay its debts. This is rare among major powers. It is politically catastrophic. It destroys credibility permanently. The United States will never choose this path. But there's a second type of default: overissuance, inflation, printing currency until the value dissolves. This allows technical repayment, but in money worth far less than borrowed. Debts are honored nominally, but purchasing power evaporates. This is the path the West is already on. The East sees this clearly. They understand the playbook, and they are responding accordingly. Moving away from dollar reserves, accumulating hard assets, building alternative payment systems, creating currency frameworks that do not depend on Western institutions. This is not hostility. This is survival. Bill Holter explains that Eastern nations view silver differently than the West. In Western financial thinking, silver is primarily industrial, a commodity, a metal used in manufacturing. Its monetary function has been largely forgotten, dismissed, treated as obsolete. But in the East, particularly in China, silver retains its monetary identity. It is recognized as the money of the people. Gold is the money of kings, the money of governments, the reserve asset of nations. But silver belongs to individuals, to savers, to those building personal wealth outside state control. This cultural distinction matters. It drives behavior. It explains accumulation patterns. Western investors chase paper returns. Eastern savers accumulate physical metal. The gold-to-silver ratio tells a revealing story. Silver comes out of the ground at roughly 9 or 10 ounces for every 1 ounce of gold. That is the natural ratio. For hundreds of years, the market ratio was 16 to 1. Silver was discounted because of transportation difficulty. It took 10 times the weight to move equivalent value. So the market applied a practical discount. Then came 1976. The COMEX began trading silver futures. The suppression mechanism activated. Over the following decades, the ratio became distorted. It reached extremes. At one point, the ratio hit 120 to 1. Gold priced at 120 times silver per ounce. An absurdity by historical standards. More recently, the ratio has compressed to approximately 63 or 64 to 1, still far from historical norms, still indicating severe silver undervaluation. And as the paper market loses control, that ratio will continue compressing, potentially back toward natural levels. Eastern accumulation accelerates this process. The buyers' nations have been discussing a new currency framework for 6 or 7 years. Not a single replacement currency, but a system of currencies backed by tangible assets. Gold, silver, commodities. The backing would be partial, perhaps 20%, perhaps 40%. Not fully convertible, but ratio-backed. This is critical distinction. Convertibility means citizens can exchange paper for metal on demand. History proves this depletes reserves rapidly. Governments learned this lesson. They will not repeat the mistake. But ratio backing provides credibility without vulnerability. A currency backed 20% by gold maintains value stability. It signals fiscal discipline, it attracts international confidence, and it does not require surrendering reserves to every redemption request. This is the future Eastern powers are building, a monetary system that functions but does not depend on Western institutions, a system backed by assets, not by debt and promises. The repositioning is nearly complete, the accumulation continues, and when the Western paper system finally breaks, the East will be ready. They have been preparing for this moment for over a decade. The question is not whether they saw it coming. The question is, did the West? There are moments in financial history when everything changes at once, not because of a single decision, not because of policy, but because reality finally overrides narrative. March 2022 marked such a moment. When Russian foreign reserves were frozen, when sovereign assets were confiscated with the stroke of a pen, something fundamental shifted in global consciousness. Nations around the world witnessed what had been theoretical become brutally real. Reserves held in Western financial systems were not safe. They could be seized, frozen, weaponized. Political considerations could override property rights instantly. The day after that confiscation, gold began moving differently, not erratically, not speculatively, but persistently, methodically. The price began climbing in a way that technical analysts recognized immediately. This was not trader behavior. This was institutional repositioning. Central banks were moving. Sovereigns were adjusting. The entire foundation of reserve management was being reconsidered. Gold moved from $1,800 to $2,000, then consolidated. It pushed toward $2,400, $2,500, then paused again. But the pauses were temporary. The direction remained clear. And then acceleration from $3,000 to $3,400 in approximately 6 months. Not a bubble, not speculation, repricing. The banks could no longer deny what was happening for 10 years. From 2015 onward, the public had been fed carefully constructed narratives. Inflation was reported at 3% annually. Employment figures showed only 4% unemployment. Government data painted a picture of stability and controlled growth. But citizens were living a different reality. Grocery bills doubled. Housing became unaffordable. Energy costs surged. The official 3% inflation figure bore no resemblance to actual experience, and people began questioning everything. If the inflation data was false, what else was false? Employment numbers, economic growth, the entire framework of official statistics. The co-situation accelerated this awakening. Narratives that were initially presented as absolute truth later proved incomplete or entirely incorrect. The alternative media, the voices dismissed as conspiracy theorists, were often proven right. Spike proteins, adverse effects, information that was censored, later acknowledged. Trust, once broken, does not easily repair. And when trust breaks in one area, it spreads to others. If the government misrepresented public health data, why trust financial data? If inflation numbers are fabricated, why believe anything else? This erosion of confidence is dangerous, not because it creates instability, but because it reveals instability that already existed. The banks faced an impossible situation. They had spent decades telling the public that gold was a barbarous relic, an outdated store of value, something only conspiracy theorists and doomsday preppers accumulated. Whole dollars. Trust the system. Believe the narrative. But then gold ran from what? $800 to $3,400 in less than 2 years. Silver began moving aggressively. The metals were screaming a message the banks could not silence, and the public was watching. Financial institutions realized they could no longer maintain the old narrative. They could not tell citizens staring at $3,400 gold that precious metals were irrelevant. They could not dismiss what people were seeing with their own eyes. So the messaging shifted subtly, quietly. Banks began acknowledging gold's role. Analysts started discussing metals allocation. The denial ended, not because banks wanted to admit reality, but because ignoring reality made them irrelevant. This creates a new problem for authorities. How do you slow the momentum without triggering panic? How do you discourage gold and silver accumulation without making it obvious you are discouraging it? Direct confiscation is too visible, too provocative. It would accelerate the very panic governments fear. So the approach will be more subtle, more bureaucratic policy tools rather than force. Expect higher capital gains taxes on precious metals, tightened reporting requirements, new regulatory classifications, restrictions that make ownership less attractive on paper without outright bans. This allows control without confrontation. It discourages participation without creating martyrs. But history teaches a clear lesson. When access to scarce assets is restricted through regulation, demand does not disappear. It shifts. Parallel markets develop. Activity moves into less transparent channels. People find ways to preserve purchasing power outside official systems. Restriction creates the very behavior it attempts to prevent. Meanwhile, the broader market reveals deeper problems. Equity markets continue rising in nominal terms. Stock indexes reach new highs. Financial media celebrates. But measured against gold, against silver, against real assets, those gains disappear. Stocks are not rising, currencies are falling. And equities simply reflect that devaluation. Capital is shifting from growth to preservation, from speculation to protection. Investors are becoming risk-averse, not because opportunities disappeared, but because systemic risk is becoming undeniable. The entire system now sits vulnerable to a single trigger event. A credit failure, a sovereign default, a breakdown in market settlement. Any one of these could cascade rapidly. Confidence operates on thin margins. Once it breaks, correction happens fast. Very fast. Bill Holter warns that what comes next is not a single dramatic event. It is gradual recognition. The understanding that the existing framework cannot absorb rising debt against shrinking confidence, that debt levels have exceeded any mathematical possibility of repayment, that money printing has diluted currencies beyond recovery. This recognition will not arrive uniformly. Some will see it early, some will see it late. But once it becomes widespread, markets move with shocking speed. There will be little time for adjustment, little opportunity for repositioning. The shift from confidence to panic happens in hours. Not weeks, not months, hours. Gold and silver prices in that environment will not reflect speculation. They will reflect structural repricing, a recalibration of what constitutes real value, what holds purchasing power, what survives systemic failure. Currencies will continue functioning. Transactions will still occur, but credibility will be shattered. Governments will be forced to lean on tangible reserves to restore trust, partial backing, ratio backing, some connection to physical assets because pure fiat will no longer command belief. This is not prediction. This is pattern. Every fiat system in history has followed this path. Onerous issuance, devaluation, loss of confidence, and eventual reset. The timeline varies, the specific triggers differ, but the outcome remains consistent. The question facing individuals, institutions, nations is not whether this unfolds. The question is positioning. What holds value when paper promises fail? What preserves wealth when currencies collapse? What remains when everything else disappears? Gold and silver do not fail. They cannot default. They do not depend on institutional solvency or government credibility. They simply exist. And in a world built on debt, that existence becomes priceless. The systemic reset is not coming. It has already begun. The repricing is underway, the control has been lost, and what comes next will redefine everything. Could this unfolding scenario mark the beginning of a new monetary era where tangible assets finally reclaim their role as the ultimate measure of value? Share your perspective in the comments below. Your insights matter, especially now. If this analysis provided clarity, share it with those who need to understand what lies ahead. The time for preparation is narrowing.